Imagine you walk into a market. You see two shops. One shop has a shirt for $2. The other shop has a shirt for $40. Your brain immediately whispers, $2 is cheap. That's a great deal. Now pause for a second. Why is that shirt only $2? Is it a gift? Or is there something wrong with it? This exact same question exists in the stock market, and most people never ask it. They only see the price, not the problem hiding behind it. Today, I want to tell you a story, a very simple story, a story about cheap stocks and why they often become the most dangerous traps for ordinary people. Stay with me, because what I'm about to explain has destroyed more investors than market crashes ever did. And once you see it, you'll never look at a cheap stock the same way again. Let me ask you a very innocent question. If a stock is trading at $1 and another stock is trading at $1,000, which one feels cheaper? Your brain answers immediately, the $1 stock. But your brain just made its first mistake, because in the stock market, price is not value. Let me explain this like you're 10 years old. Imagine two pizzas. Pizza A costs $1, pizza B costs $10. Sounds easy, right? But here's the twist. Pizza A is the size of your palm. Pizza B is the size of your dining table. Now tell me honestly, which pizza is actually cheaper? Exactly. The one that looks expensive. Stocks work the same way. A $1 stock is not cheap just because the number is small, and a $1,000 stock is not expensive just because the number is big. Yet most beginners never learn this. They see a low number, and their brain screams, opportunity. And this is where the danger begins. Because cheap-looking stocks attract emotional buyers, not smart buyers. And emotional buyers always pay the highest price later. But why do so many people still fall into this trap? Your brain was designed for survival, not investing. Thousands of years ago, finding cheap food meant staying alive. So today when your brain sees something cheap, it releases a tiny feeling of happiness, a reward. That same ancient brain now looks at stocks, and when it sees a stock priced at $1, it thinks, I can buy more shares. I can get rich faster. If it goes to $10, I'll be a hero. Notice something important. Your brain doesn't ask, why is it $1? It only dreams about, what if it goes up? This is not logic. This is hope, and hope is extremely dangerous in markets. Because markets do not reward hope, they reward truth. But cheap stocks are experts at hiding the truth. So what truth are they hiding? Let's go one layer deeper. Here is a hard truth. Stocks don't become cheap by accident. Companies don't wake up one morning and say, let's make our stock cheap today. Prices fall for reasons. Sometimes small reasons, sometimes deadly reasons. And cheap stocks usually carry heavy baggage. Let me explain with a simple real-life example. Imagine a house for sale. One house costs $500,000. Another house costs $50,000. Why is it so cheap? Because the roof is broken, the walls are cracked, the foundation is weak. Nobody wants to live there. Now tell me, is that house cheap? Or is it expensive pain waiting to happen? Exactly. Cheap stocks often look attractive, but they are cheap because something is broken inside. Maybe. The company is losing money. The business model is dying. Debt is crushing them. Management is clueless. Customers are leaving. Technology has replaced them. But beginners don't see this. They only see the price. And price alone tells you nothing. This sentence has destroyed millions of portfolios. If this stock just goes back to where it was before, let me stop you right there. Stocks are not rubber bands. They don't have to bounce back. Imagine a person who was once healthy, then got very sick. Do they automatically return to full health? No. Some recover, some don't. Some never walk again. Same with companies. A stock that was once $100 and is now $5 is not cheap. It might be dying. And hoping it will go back is not investing. It's gambling. Here's the painful truth. Most cheap stocks never return to their old highs. They slowly bleed, reverse split, get delisted, disappear, and nobody rings a bell when that happens. Which brings us to the most dangerous part of cheap stocks. Market crashes are loud. Everyone sees them. Everyone talks about them. Cheap stocks are silent killers. They don't crash in one day. They fall 2%, 3%, 5%, again. Slow enough that you don't panic. You tell yourself, it will recover. I'll wait. It can't go lower. But it keeps going lower and lower until one day you stop checking. This is how people lose money without realizing it. Cheap stocks don't break your heart in one blow. They slowly drain your confidence. And once confidence is gone, people make desperate decisions, which leads to the final and most important lesson. Let me redefine cheap for you. Cheap does not mean low price, many shares, big percentage upside. Cheap means strong business, honest management, stable cash flow, real customers, a future that makes sense. A $500 stock with a powerful business is cheaper than a $1 stock with no future, always. Smart investors don't ask, how cheap is the stock? They ask, how strong is the business? And that one question changes everything. Let me leave you with this. In the stock market, the most expensive lesson is buying something just because it looks cheap. Cheap stocks don't make you rich faster. They make you poor quietly. Next time you see a stock priced very low, don't feel excitement. Feel curiosity. Ask, what is broken here? Because in markets, price whispers, but truth always speaks louder. If you understood this story, you are already ahead of most investors.